Today's going to be a good call because normally in previous investor calls, we've discussed what's going on with the fund on a macro level, macroeconomic stuff like housing and just general fund updates. But this particular investor call is going to be a little bit more special because I've got one of my partners, co-founders on the call with us, Dave, and he's going to join us today to talk about something that's near and dear to everyone's heart, which is how we underwrite good and safe and good loans that underpin everything that Trophy Point does. And Dave is the heart of that. He leads that effort for us. So let's just jump straight in. I'm going to give a few minutes of the fund for those of you that are new, and then we'll jump into Dave. And like always, we'll try to keep this 45 minutes total. So like I said, we're going to talk about our underwriting today. So if you don't know who we are, and I see a few names that I'm not familiar with, my name is Samir Patel. I'm the managing partner of Trophy Point. And I love real estate. I own real estate. I teach real estate part-time. I've overseen a lot of deals in my career. And like Dave, I'm also an Army officer serving in the reserves. And probably more than anything else, I love being here to help. I love talking deals. I love talking about risks. Mike Martin, as you can see on the quotes on the bottom of the slide here, I take pleasure in like helping people not lose money, actually more than anything else, because as many of you on this call, we've earned a lot of money through our hard-earned work, effort, savings, and you really don't, especially in the real estate game, you really don't want to risk money that you have for money you don't necessarily need. In my opinion, real estate is largely about not losing and just slowly compounding your wealth. And Dave actually coined a term that's been on my mind for the last month. He calls it survive in advance. And I'll let Dave talk more about that mindset because I think that's a fantastic way to think about real estate. So I don't want to steal from Dave's thunder, but anyway, I'm always here to help. So there's my phone number. Feel free to reach out anytime. If you're interested in investing, there's a QR code as well that you can scan and set up a call with myself or Max. So I'll introduce Dave and I'll do my updates and then I'll jump into Dave. But Dave oversees all of our loan policies at Trophy Point and he ensures that the portfolio that we manage of loans, and now it's about 360, 370 loans at any given time, that all of those loans are performing. And he does a really good job because we've done 1,200 loans over the last 4 years and our default rate is extremely low, which is good because as you know, Dave, myself, and Nick, our other partner, we take the first loss on any bad deal we do. So Dave is responsible for making sure that me and Nick don't lose money out of the personal wealth that we've invested in Trophy Point. So I'll let Dave get into his bio a little bit later, but that's the high level overview of Dave. And he's also a lawyer and a West Point grad as well. So if you're not familiar with Trophy Point, the best way to think about our business model is like we're like a private bank. We take your money as a depositor, even though we don't use that term. We take your money, we give you 8 to 10.5% on it. We pay it quarterly, or you can compound it if you want on a quarterly basis. And then we take your money and we lend it out at higher rates on real estate value add deals. And we usually have we always have a first position lien. We're always senior in the debt stack. We, have $8 million personally invested and we take the first loss, which makes us extremely unique when compared to other debt funds out there. No, I don't know of any other funds that have the partner so personally invested and are willing to take the first loss on whatever bad decisions they make, which I think is great for you as an investor because it means that we're completely aligned with your money and we're protecting it. And we're willing to lose ourselves first before a single dollar of yours is touched. So I think our return relative to the safety and the risk mitigation measures that we put into our portfolio, which Dave will talk about, we're probably the best option in terms of earning a stable yield that I would say is somewhat liquid. We do lock your money up for a little bit of time, but we still have a higher degree of liquidity compared to the 5-year, 10-year lockups that you're now seeing in debt funds. Our lockup period is only 18 months for new investors. And so we blow REITs, treasuries, and stocks out of the water when it comes to yields. And we do it in a safe, stable manner, meaning that the check always comes on time, it's always paid quarterly, and we just continue to advance as we go forth. There's very little volatility in what we do. And so our latest milestones is we hit 240 million in originations. We've originated, actually it's close to 1,200 now. And more importantly, we've gotten paid back on 130 million because anybody can send money out the door. That's easier. Getting paid back and making sure the decision you made 6-9 months ago, getting paid back is is a greater measure of success. And you're going to be talking and hearing from the guy that ensures that that happens. So July, quick snapshot on July. May was like our largest month ever, actually, in terms of loans made by dollar volume. But June and July seem to be pretty steady months as well. And then you can tell also that the economy is still humming along, despite what you're hearing in the news, that loans are still paying back. And that's what we care about at Trophy Point is the velocity of trades. We can go back and forth on rates. We can go back and forth on like housing values, so to speak. But what we care about really at Trophy Point is our houses and assets trading, continually trading left and right, buying and selling. Is that continually happening? And that is actually the primary sign of a healthy market. So our fund is almost 100 million and we manage about 370 loans at any given time. So our offerings, like I said, you can take a snapshot of this if you'd like. They're also on our website, but we have 8 and 10, 10.5% products, and it's divided by standard accounts, standard investments, and retirement. And we like our retirement folk more so because selfishly speaking, you're less likely to redeem your money. And I think earning 10% in a retirement account that compounds on a quarterly basis is a fantastic way to grow wealth. And so 8 and 10 on the standard side, 2-year lockups, and the retirement accounts, same lockup period, but we like to incentivize folks to invest through retirement accounts, which you must do through a custodian. And we're happy to help set that up for you if desired. We have a pilot program. So based on investor feedback, there has been some desire for flexible, very liquid, and somewhat high yield note offering. So what we've come up with as a pilot, and it's not fully baked out yet, so we're really, we want you to pilot it with us if you can. We earn a 7% annualized return, and there's no lockup, just a 30-day notice for redemption. That's it. We think it's great for business owners. We think it's great for folks in real estate who have to hang on to a lot of cash for reserves and things like that. We think it's a great way to earn a decent yield and get the money when you need it within 30 days. So hit me up on my email if you have questions or want to be added to the waiting list. We've got about 10 people in the waiting list that want to experiment with this, and we'd love to get your feedback as we refine it further. So I'd like to hand it over to Dave at this point. Like I said, Dave is our COO. He manages and oversees our entire lending operation. And Dave, from the very beginning, from the very first loan we did, has a strong hand and oversight over how we underwrite these loans to ensure that they're safer, the borrower is capable of paying, and the borrower is capable of executing the project that they have requested a loan for. So Dave, I'd love for you to, just to start off with, actually, maybe talk about Survive in Advance for the audience, and maybe start with that, and then we can dive into your slides as well.
No, absolutely. Thanks so much, Samir. So I can't take full credit for that phrase. So anybody, if you're a college basketball fan, when the famed North Carolina State basketball team made a run in the NCAA tournament, they were coached by the late great Jim Valvano, which you've probably heard of. The term that he coined was, "We are going to survive in advance" in the tournament, meaning they had to continually win, and if they lost, they were done. And so they ended up winning the NCAA championship that year. What it means, to me, and I hope, gives all of you some confidence, because this is, what we're trying to instill in our team, is that in order to continue to be able to deliver you all, exceptional returns, to be able to deliver exceptional client service to our clients, our borrowers, is we must be able to make responsible loans that are going to pay off in any economy, under any circumstance. If we continue to do that, we will be in business tomorrow. And then on the margins, on the fringes, we want to advance, meaning we want to continue to be providing better client service, better investor service, increasing our standards in underwriting, providing new tools, new partners that are going to allow us to provide a better snapshot of the risk we're actually taking. We're going to originate more loans. We're going to make better margin on those loans. That's what I mean when advance. Every year, every month, every quarter, we as a business should be getting better to help benefit the two, unique individuals that we are here to serve, which is you, the investors, and our clients who are borrowers. So that's what I mean by survive in advance, the way I think about it. And I think this chart is actually a really good way to kick off and think about that. Is I want to reorient everybody where we are, because it's a unique time and unique space. And our news cycles will constantly try to tell us about that in a certain way. And I like to go to the data. So the data I use is always from a third-party source. This is from Statista. And the bottom line is when you look at this, you can see what was really the genesis of private lending. If you go back to the year 2000, there was very little capital involved in private credit and private lending. The numbers we have, and they aren't very reliable because it was so small, is maybe somewhere around 30 to 50 billion dollars is where we at for 2001 to 2002 timeframe. And now this is going to be very soon a multi-trillion-dollar market. So you can see in a very short amount of time that we went from billions to trillions. And this tells the story as to why, which is what we know as the great financial collapse or great financial recession here. And so we see, in 2005, that's when people were doing ninja loans. Going back to underwriting, anybody that knows what ninja loans are, which is no income, no job, no assets. This was a complete and utter, lack of responsibility on lenders' part because why? They weren't doing the due diligence they needed. What is underwriting? It's due diligence. It's figuring out, is the person going to be able to pay back the loan that you're originating? That's it. It's really not too difficult, but it does require you to do something. And on a ninja loan, we weren't doing that. And as a result, the lack of underwriting led to a collapse in prices. It ran to a run up and a spike in prices to a point where they were no longer sustainable. Those financial institutions collapsed. And then the number of homes that were sold as a result went down. So you can see 2008 through 2011 was nearly flat. We went up almost 7 million sold down to 4. That's a huge percentage difference when you think about the number of total people in the US, the number of people that need housing, and yet we almost went to a standstill for 4 years. We have a slow buildup you see going back from 4 all the way again, spiking in 2021 to 6 million. That's a 50% increase over that time. And again, you see as interest rates rose, what happened when the interest rates rose? We have another correction in the form of what we're seeing today, which is consumers today, based on their assets and based on the fact that underwriting is more strict today, they do not have the income or the assets to be able to buy at the current price point, given the fact that the price is higher because their monthly payment is higher. Why is their monthly payment higher? The interest rates. The interest rates are driving that. And as a result, you see a very low number of total transactions. What does this mean for you as the investor? What does that mean for us as our clients? Well, one is when you're looking for the type of individuals, the experienced individuals we're doing business with, there are fewer people that are ultimately buying houses. That affects our clients who are trying to sell them, right? That affects the price at which they're able to sell them at. The second point of this is, where is this going? Because our competition, these other lenders, that has increased. So from 2005 to 2025, in that 20-year span, the amount of capital is 10x what it was. So we have more competition against less houses selling, right? That is the framework that we go ahead and move to. So Samir, next slide, please.
Yeah. And real quick announcement. Feel free to use the Q&A button at the bottom of your screen or on the Zoom panel. I will help moderate and we'll answer questions as we go along, but feel free to use that Q&A button and I'll be monitoring it.
Absolutely, yeah. And I apologize for not leaning out with that. I want to make sure that if you have a question, yeah, let's answer it while we're on that topic. Happy to do that in line. You have to wait till the end. So we're now in 2025. You see what's on the news about economic uncertainty and inflation pressures. When you think of real estate, the number one thing that can influence real estate as far as values and transaction volume that you just saw is uncertainty. When individuals have uncertainty in their income, that means there is a lack of their ability to secure long-term financing to buy houses, which means the number of units sold is going to go down. So if you look back at that slide I had earlier, if you look at 2026, 2027, these are guesses, right? But I would, suspect that we're going to see a largely flat environment in terms of number of houses sold. That is a likely outcome. Again, I'm not a magician or somebody that can look in the future, but I can tell you that anytime you see economic uncertainty, you're always going to see that impact real estate. And you can see all those current market risks, but the bottom line, the way to sum that up is, as long as the economy is uncertain, as long as interest rates are high, you're going to see low transaction volume. I think that's just a safe assumption at this point. Where does this affect us as a private lender? Well, there's less transactions happening, but we also have more people we're competing with and against. So the other private lenders in the industry also are going after the same type of clients. and the same number of, houses or units sold. And so, if you go back and rewind the clock 10 years ago, we had far fewer people that were making loans and there was more transactions happening. So we're all targeting, a smaller pool and demographic of people and number of transactions we're going with. What does that mean for us? Well, it means that there's going to be pricing, shock. It's harder to charge 13 or 14% in this market as a private lender because somebody else is out there offering 9.95 or 10.5%. That makes it difficult. You know, it also, we have to look at our underwriting criteria, right? We've got to ensure that when we're competing against a smaller and a finite group of and pool of people, that we've got to make sure that their assets, their income, and their experience are measuring up to, our standards. The things that are impacting us there, we're looking at interest rates. We can't control them. All we can do is watch. And then we're going to look at your housing demand and supply. Samir, you've talked about this since day one, and I think it rings true. Our population during that entire graph, even though there's a decline number of transactions, what's happening? Our population is still generally increasing. I know there's been a lot of articles about, people not having as many children, et cetera. That is for many years down the road. In the near term, especially for the next at least 30 years, we have a great shortage and a huge demand for housing. And so despite the fact you're not seeing transactions happening as many and as rapidly, there is still a huge demand. What does that tell me? It tells me that eventually, as we get some more clarity and certainty on the economic future and we have some stability there, and as interest rates come down, you're going to see another increase, right, in transaction volume. Our goal is that we need to have a team, a pool of capital, and underwriting process to meet that demand, because there's going to be a demand coming when we get to that part. Next slide.
Hey, real quick, Dave, we got a question from an anonymous attendee. Is it more
Wonderful.
challenging right now to find good deals that meet your underwriting criteria or raising the capital needed to fund the loans? So is it more challenging to find deals that meet our criteria versus raising the money to fund those loans?
Oh, great question. I'll kick off the first part. Samir, I'll let you handle the second
Okay.
half since we'll stick to what we're good at. And so I could tell you from a deals perspective, again, Samir kind of talked high level about our numbers. We're on track to do about 100 to 110 million dollars of originations. That to me, especially if you talk to a 10 years ago me, that seems like a lot of money, and it is. And we don't take that responsibility lightly. That is a very, very small fraction of the private loans and lending in the United States. That's a good news story for us as an institution because that ensures that we can still be selective while doing that amount of volume. And I'm going to contrast that with some of our competitors. Many of our competitors that are doing, $1 billion, $2 billion of origination in a year, those individuals, when there is a downturn in the economy like this and transactions go low, it makes it very hard for them to be able to meet their overhead obligations, their size, all the things that a large organization like that has to overcome. We don't have that. And so as a result, we can continue making responsible loans and not get, not get careless with our underwriting criteria, right? We're not reaching to do bad deals. We're continuing to stay within our box and actually tighten our box. So to answer your question, the short answer is I believe that at our current size and even at, 100% larger, we are very much in a good place to be able to continue to do responsible loans and find good deals.
Yeah, and to add to Dave's point real quick, and I'll talk about the capital raising side. Our best form of marketing to borrowers is great customer service, and we pride ourselves on that. And I think that's a major reason why 60% of our borrowers are repeat borrowers that come back for second, third, fourth, some
Exactly.
cases 50th, 100th loan as well, right? So we haven't had challenges yet in terms of finding deals, but it could happen, we never know. And then on the raising capital side, it's not a challenge anymore. And I'll give a shout out to Danielle Banks, who some of you on this call know is our head of investor relations. She leads that team now. And we haven't had any problems raising money. Considering our reputation, our track record, and we've been doing this for a while now, we're a known entity in many, many investing circles. So it hasn't been bad.
Yeah, and I'll add one more thing you can say on this slide with the underwriting piece is we're getting a lot more calls from banking institutions, right? Because in this area of uncertainty, those banks are looking for a way to deploy capital at high yields, and so they're having a hard time doing that internally, and they certainly have to have a lot of overhead to do so. And when they can use us as a conduit to do that, that makes them sleep very well at night, and they don't have to deal with, trying to do all the overhead of having a underwriter, a loan officer, all the things it takes to originate one loan. We can do that for them. And so that's been a huge, tailwind for us to be able to help grow capital over time. All right. So what we're here to talk about, and I went through, the history of private lending over the last 20 years to kind of bring us home to what underwriting is and why we do it. And so this is how we're able to look at any given deal or transaction and decide if we want to, in fact, lend money to the client. The reason we do this is to protect us as an organization, to protect our financial investment in this property as the senior lien holder, as Samir said earlier, but it's most importantly to protect our partners. That's you, the investor, our credit partners, our banks. We want to ensure that all of you have faith, trust, and confidence in our ability to continue to support and pay back your money. But more importantly, it's to be responsible. It's responsibility to our clients to ensure that they're going to make money. Because at the end of the day, while we can't guarantee that they're going to make money, we can do a darn good job of trying to. Because if I do one loan with a client and they lose money, they never come back for a second, third, or fourth transaction, right? So our goal is we want to be able to have an honest conversation with them and say, hey, I don't think this is a good one for you. Let's go look at the next one. And we have turned down many loans on our team. And honestly, every day the number of loans we're turning down increases, which should give you some confidence as well. And we turn those down because we don't believe there's a likelihood of them paying back because they don't meet some of these criteria. And we recommend that they go find a better deal. Having that honest conversation actually gets us to Samir's point about marketing. It has gained us a reputation of being a responsible and honest lender. I think that's really important. So you see the processes here, the purpose, the components, and all that stuff. The real thing that you're coming through is the outcome. The outcome is we are approving loans that are responsible versus, approving any loan that comes in the door. And over time, next slide, please. We have refined this process and how we go about doing it. So everything that you see along here as I talk about it, these are all, basically, third party or outside information generated. Again, that should give you confidence as this isn't Dave Marold or Samir Patel or, even our underwriter or loan originator's opinion, right? We're actually pulling data from other outside sources that are validating it to determine whether or not this is a good deal for us to do. The first one I'm going to talk about is Mortgage Automator. So when we started this was simply emails going back and forth. And Samir remembers those early days where we would get, 50 attachments from a borrower and we'd have to decipher what all that means. What Mortgage Automator does is it takes all this information about the client and is able for us to organize it in such a fashion that it's easier and quicker for us to get to the root of what this asset is worth, what the client is worth, and can they pay it back. That's what Mortgage Automator does. It takes all this information on the right side of this and brings it all together. One of the first things we start with is a credit check. And so we use a tri-merge credit report on all of our borrowers. There are two ways, if you're familiar with the credit industry, you can pull this. These are known as hard pulls and soft pulls. From our standpoint, the goal of a credit check is determine one, what other things do they owe, right? We want to see, do they have other debts and are they paying them on time? That allows us to kind of be a huge predictor in the form of a credit score, whether or not we're likely to get paid back. The second piece of it, though, is determine just, from a logistics standpoint, can they make their monthly payment? So when we see they have two credit cards, one Mercedes-Benz, and $1 million house, right? And all of this adds up to a $6,000 a month payment. And let's say their payment to us is $1,000, they've got to be able to pay $7,000 a month. And so if I find and substantiate that their income is $3,000 a month, these two aren't compatible. Logistically, there's no way underwriting that tells us that this person can do it. On the flip side, if they're bringing in $20,000 a month and they owe seven, right? That's a DTI of less than 50%. That is a client that we feel very strongly has a high likelihood of paying back not only us, but all of their other debt obligations on a monthly basis. So that's where the credit checks are very helpful for us to be able to get a very quick assertion of their just overall credit, health. Experience. What we're trying to determine and what we are targeting more and more, and you saw this earlier, is we want to go after experienced borrowers, people that have done, more than 10 deals. And so when we first started this, you'll hear us talk about, we always do veteran, military affiliated. That was a proxy for how, likely we thought that person was to succeed because they have project management experience in the military. But every military person knows 10 other people that are not in the military that are great in this particular industry because of the amount of deals they've done. So as we grow our loan profile, the percentage of people we do just by natural happenstance is going to be less percent in terms of military, right? So if before, let's say we were at, 30, 40, 50, 60% military, that percentage is over time as we grow going to go down. Why? Because only about, 1 to 2% of the whole population serves the military. So as we expand, the percentage of clients or borrowers naturally will go down as military. So what do we have to do now? We don't have the trust and confidence necessarily by military service, but we can certainly look at their success, right? And we look at success, or we deem it, is based on exits, successful exits. That means they sold for more than they borrowed previously, or they've refinanced that loan and they are into a 30-year mortgage and they're renting it out and getting a rent payment from paying tenants. That's what we're thinking about in terms of experience. One of the newest tools to our arsenal is the background verification. So again, when we started this, we had none of these things to be able to help our underwriting process. So what you should feel like is every single quarter, year that we've done this, we're getting better, right? We're increasing the amount of information we have on any given individual. And that is, further honing what it is we can lend on the asset and ascertain the risk. So the clear check, so anybody that's been in the airport and they try to get through fast, right? That's Thomson Reuters. At the end of the day, what your clear check, can ascertain at the airport is the same thing we can ascertain as a lender. And that is, we're aggregating data across the entire world on this one individual and their businesses. So for example, if our borrower got pulled over for a speeding ticket in Germany, we can actually see that through the clear check, right? Again, that may or may not have an impact on the loan, but at least we'll know it. It can give all kinds of information on distress regarding, any type of liens they have on personal assets or businesses. It can tell us if that person's ever been through bankruptcy. It can tell us whether or not that person has been sued or currently in a lawsuit. All these things that can impair that client, we get that data today as opposed to learning it tomorrow once we've done the loan, which is not when we want to learn about it. The final one, we are proud to partner with a company called Richer Values. And so many of you that have done even a home loan, one of the biggest pains in any lending area is an appraisal. And so when you go to buy your first house, your first condo, your townhome, every one of those traditional lenders are going to require that you have a appraisal done to determine what the value is of the asset you're lending on. And again, this is an area where we've improved and we've partnered with what we believe is a wonderful company, because it's not our opinion of what the value is, right? It's a third party that is looking at the asset today, taking the pictures of exactly what it is today and determining the value today. And many of our projects are actually going to be improved because they're going to fix it up. A fix and flip loan, by definition, is somebody that's going to rehabilitate a property that is not in good condition today. And so Richer Values then looks at the scope of work. That is they're going to put new shingles on the roof. They're going to put new paint on the interior, new windows. It's going to take into account all of those repairs, the value of those repairs, and assign a new value to that property. That's what we call the ARV, the after repair value. And that allows us to understand what that project will be worth when it's completed. So we look at both what it's worth today and what it's worth on the backside. And again, we're using a third party to do that. And that's how we ensure and keep a check on ourselves, right? So that's not just our feeling about it, but somebody else's feeling about it as well. And partnering with them allows us to get that value much quicker than a traditional appraiser. And that in turn is better client service for our individuals that borrow with us so that they can get those deals done faster, which is an advantage for us as a lender. Next slide. All right. There are two great things, and one of the reasons I think Samir and I both love this, asset class and investing in this area is that you kind of have a backup plan when things go wrong. It's not necessarily what you want to do, but again, remember the motto, right? It's survive and advance, right? In order to survive something that doesn't go well, if you have no backup for that, that's a really difficult business to be in. And there's many businesses that, hey, this is the way, this is how you do it. And if you don't, you lose money. Here, we kind of have multiple ways to ensure that we get paid back, which is our ultimate goal, and to make sure that you as the investor are made whole. And so, and I'm actually going to reverse these, right? Because ultimately, the client in many ways is kind of what we're looking at, right? We're looking at that individual and we're saying, hey, look, is this person going to be able to carry this whole project across the finish line? Have they done it before? Do they have the financial resources to make the down payment that they say they're going to make? Do they have the reoccurring income outside of real estate to be able to pay us back every month during the life of this loan? Do they have any other financial distress, judgments, liens, bankruptcy, right? All these things that we're trying to figure out about that individual to see if they just even get over the bar to do the loan itself, right? So this is like the initial barriers. We've got to make sure that client is just a personable that we want to bank with. But just because you're a good client and you've got all these things, it doesn't mean we're going to do the loan, right? Then we're going to shift and we're going to look at the asset. And the asset is, hey, if for some reason something happens in the life of this client tomorrow after the loan is made, can we take the asset and make ourselves whole just on the asset alone? So the first thing, like Samir mentioned, is you need to have a lien on the property. It's not just you give money to somebody, you're actually taking a legal responsibility in this process, and your collateral for it is the asset. Oftentimes, I'm working on a deal right now. We might take multiple assets. So even though you're going to work on one property, we might take 2 additional properties in your portfolio to secure our position. So we've got additional risk mitigation on that. We're also not going to lend you, 100% of the ARV in these cases, right? The ARV is going to be significantly higher than the amount that we're lending out. That gives us a cushion in case of what? In case that we have a market recession, which if you aren't seeing, and you saw the stats earlier of transaction volume going down, as transaction volume goes down, the price of assets goes down. And so we're seeing this, that if we make a loan 12 months ago and we predict what the ARV is going to be, we're often seeing that ARV be 5 or 10% lower today than what it was. But guess what? We've got 25% margin built in, right? 25% margin minus 10, we still have that 15% margin of safety. And so that's how we ensure that that asset stays where we want it to be. We like the fact that our assets, generally speaking, are smaller. 234K is, a small loan size relative to many markets if you look across the US. I mean, California, I'm not sure if you can buy like, a 10 by 10 piece of land for 234K, let alone a house. And so what the markets that we're looking to do business in are not your San Francisco, LA, New York City. That's never going to be our target marketplace, because we want to target, secondary, tertiary cities that are in, working class neighborhoods, right? Where teachers, plumbers, electricians, these people need housing and need quality housing. And so taking older homes in those neighborhoods, bringing them back up to being one of the nicer, houses in the block, that's where these type of loan sizes are. I mentioned earlier, title is really important, because before we do the transaction lend on it, we've got to ensure that nobody else has a claim to that property. There can often be, tax liens, there can be judgments, all things that are tied to that property. If we lend money on that property, our client and us are assuming the risk of paying those things off. So if that exists and we don't find clear title, that's money that's going to be owed that's not factored in the deal. That's additional risk that we don't want to take. And then the last thing, it goes back to vetting experience. We want to know not only what the plan is, but we want to see proof that this individual has executed a plan like this before. And that experience really is kind of the key to what we're trying to do here. And obviously, asset class, no industrial, office space, self-storage. Our thesis is if somebody can sleep in at night, it's going to be able to weather all economic storms, recessions, because at the end of the day, even when we have a good economy, bad economies, people have to have a place to sleep. They don't necessarily need office space. They may not need medical offices. They may not need self-storage, but they will need a home to put their head on. And we believe that helps protect this asset class in a way that the others are not.
And real quick, let me add to that. Part of our asset underwriting criteria has a lot to do with us actually as well. And the way we look at that is, what's the worst case scenario if we had to foreclose on an asset? And one of the reasons why we like smaller loans, in this case $240,000, is that if the median home price in America is 400, and the market generally is accepting of that 400K median home price, well, then the available pool of buyers to buy a 300, like a $240,000, $300,000 home is a lot bigger. So if we had to foreclose on it, we have the ability, and assuming we lend at 75% ARV, we have the ability to unload a property fairly quickly to get our money back into the fund. And actually, in certain instances, we've actually made money. our goal is never to foreclose just to simply make money on a deal. We don't operate that way. But in many instances, a lot of our foreclosures end up actually making us money, which is a good thing because that means that the asset, the juice inside the asset was worth the loan basis that we were exposed to in the first
And
place.
I'll highlight that an example. Imagine if we were to lend in California, which we do not, and we lend on a $2 million duplex. If we have just a 10% market correction, that's $200,000. The amount that we would lose on that one particular, or a client could lose on that property, is almost the same amount as our total loan size in the markets we operate in, right? That's a amazing way to think about how, from a percentage basis, when you have small market corrections, how it can have outsized impact on the dollar amount from a whole dollar figure in a long-term situation. Next
Yeah.
slide, please. All right. So this is kind of, I'd say, the newest thing to really think about, in addition to all of our third-party vendors that are helping us become more secure. And that is, and I highlighted this earlier, the great competition, which is there are more private lenders today than there were yesterday, and there'll be more private lenders tomorrow than there are today. All of us are trying to find the same client, right? Which is somebody who's reliable and always pays back money. That's what we're all after, right? We're after the same person. The difference, we believe, is we are one of the larger, getting to be one of the larger balance sheet lenders. So I mentioned billion-dollar lenders earlier. They have a very different business model than us, and their business model is to do a lot of loans and then sell them off at a securitization, right? So that's how they make money. They actually lose money at origination in many cases when you look at some of their balance sheets that are publicly available. We are keeping these for the life of the loan, and we are also servicing these, which means we are a client-centric organization. We are here to serve our clients who are our borrowers. In line with that, we are seeking, and we have increased our sales team as far as the number of personnel, and all of our marketing outreach efforts, moving forward, are trying to find people that are in that sweet spot of 10 to 20, maybe 30 deals, right? And we know that they're growing. They've had the past trajectory. They've got a dedicated team and asset to be able to do this more. And they've got operations in place to ensure that they're going to have good deals moving forward. So we're looking at targeting these individuals. And once we have a call with them and we can prove to them that our client service is exceptional, that we can create a loan package that's going to fit them in a way that a larger lender who only has options A and B, they can't do that. So once we do that, they actually are going through a whole nother layer of due diligence. So before we start the process with that high volume person, which we believe is going to yield 10, 20, 30 loans a year, we want to actually do an additional risk mitigation. So before all those things I talked about, we still will do each one of those things on a per deal basis. This is done upfront on their entire portfolio to see if they qualify as that person. So the first thing is, what does their past performance look like, right? So we're looking to see, what are those exits that we've done the last 2 years, and have they been in business for more than 4? Because somebody that's done this for 12 months and had a little bit of success, there could be a little bit luck involved with that, or it could be a market that kind of carried them upward, even though they were making a lot of mistakes. So when somebody's been in the game longer, they will have been able to weather storms, more recently. And that shows that they've got the ability to have staying power, again, surviving through any market. Operations review. So we're looking, how are they gaining these properties? They have to have a marketing team. That's kind of the key for many of our really good clients, is they are buying these at 40, 50, 60 cents on the dollar. It's not because they're going on the MLS. They are out there on the offensive, targeting the properties they want and the people they want to do business with to get them on a deal. They have transaction coordinators, project managers, and then people in place to be able to sell or manage these properties at any given time, which means if they got hit by a bus tomorrow, the operation would still run. So again, we talk about the asset and we talk about, the individual. That individual at any given time can have some type of stress in there, but if they have a good operation in place, it'll perpetuate in a difficult time. We look at the loans they're doing. Again, if this person's doing a lot of loans in California, probably not the individual we're looking for. We're looking for people that are doing those type of loan sizes that we want to compete with, and we want to do it on shorter terms. I mentioned earlier that there's great pricing competition. For us, one of our competitive advantages is, as we limit the loan term, as the loan term goes lower, and as the total deal size goes lower, our IRR, or our return, can increase. So we can't compete price-wise necessarily on $1 million deals in California that go 24 months, but on a $120,000 deal in Virginia or Ohio for 3 to 6 months, we are very competitive in that area. And so that's why we look at the assets to see, is our long-term return as we do more business with these people going to yield us a profitable result? And then the last part, yeah, just looking at the type of assets, obviously they have to be residential and in markets we serve. Next slide. So
Great.
I don't want to say that's all I have because I'm happy to answer any questions, whether it's underwriting, whether it's the state of the market, where we're going in the future. But I am going to first of all say thank you. Thank you for tuning in today, taking the most valuable resource of all, and that is time to spend with us. And the second thing is thank you for investing with us, trusting us with your hard-earned dollars, your retirement, all those things. We really appreciate it. I hope that this gives you an insight into how we are, being good stewards of those funds on a daily basis with our team. And I'll stay on to answer any questions about that. Thank you.
Awesome. Thanks a lot, Dave. And while you're typing up your questions, we got one already in the chute. But Dave and I we'll lose our money first before you do, right? And so, selfishly speaking, we are very interested in making sure we do good deals. We're not just taking your money and we're not slinging it around to anybody out there. So Matt Purdy, Matt, you got a question? What is the
Yeah.
default rate among our borrowers? How often do they miss payments or fail to pay back loans?
Absolutely. Great question, Matt. So I'll answer this in a couple different ways because we are often building layers of security around this particular question and scenario because it's the one thing that I think would keep any of us up at night is protecting against, scenarios that go bad. So historically, what we have found is, on a total loss adjusted basis, we're probably somewhere around, 0.6% of a loss percentage on borrowers. So what's that mean? That's 60 basis points. That's a fraction, right? Less than 1% in this area. Framed differently, we now are handicapping, all of our loans on an annual basis to a 1.5% loss basis. So on a loan portfolio of $100 million, we are going and putting in the balance sheet that we may experience a $1.5 million loss. But from a standpoint of what we're actually experiencing, it's closer to $600,000 in that example. Now that's historical. Why do I use the word historical? If you look at that chart earlier, the very thing I started with is real estate is all about a long-term game. It is not a 6 or 12-month snapshot. So for several years, our number was zero, right? And then it can spike and come back down. And so the goal is how do you maintain that over a long period of time, a 10, 20-year track record? And so the way we do that is you do the second part of your question is, are they missing payments, right? These are leading indicators of when things may go south. And so what we want to do is ensure that if, a normal bank will look at a loan and say, well, as long as they catch up within 90 days, typically they will not foreclose. 90 days is kind of the industry standard when it comes to this. We actually start looking at this on day 15. And once we go to day 31, we now, as our process and procedure, shift that loan to our special servicing department. It does no longer is in the regular servicing bucket. That's a big difference compared to a lot of our competitors who wait 90 days for a problem to fester. We are now getting ahead of that at day 31. And so I think that is what happens. Again, how often does that happen? On a portfolio of, I think it's 367 is where we're at or something like that today. Last month, I believe on a missed payment schedule, once we finally got to the end of the month and we resolved what was left over, I think it was like 20 is where we're at or something like that. So it's not big, right? It's a fraction of the overall pool. And then they get, basically between day 31 and 60, we're either going to foreclose and take back the property or they're going to come current. But we make sure to take care of those in a much quicker way. Matt, did I answer your questions or any other things that follow up on that? And I'll let Samir, I think he's got something he wants to add.
Yeah, I did want to add. So to clarify or to add to what Dave said is when we impair the balance sheet, we're actually setting aside cash and we're putting it somewhere else. And so we've got, almost $3 million sitting aside, basically in the form of insurance. You could really look at it that way, that indemnifies the portfolio. So we're literally, even though we're impairing 1.5%, the actual loss is coming out to 0.6. But then actually more importantly, like the net investor loss is still zero because we've got profit fees and even gains on sale from the defaulted loans as well if we do foreclose or when we foreclose that actually negate all of it. So we're still, it kind of depends on how you define default. The
But yeah,
second
the rate Yeah, the want to go back to rate. The other piece is we have our captive insurance company, right? So that's another way. So we have, two layers of indemnity against these events, so that basically our net loss is zero. Zero. There's no actual loss, but there is an anticipated loss that we have two forms of insurance against,
Yeah.
essentially, to make sure that we protect it, so that we never get to the third line of where we actually lose money.
Yep. Then we got another question, and we'll end in a couple minutes here. You mentioned pricing compression. Are you varying the interest rate you charge? And if so, how is that passed through to investors? So I'll just take this one, Dave. So yeah, the bottom line is we do vary the interest rate we charge to borrowers based on a variety of factors. Actually, the same factors that Dave just talked about over the last 20 minutes.
Credit score, experience,
Yep.
asset value.
Yep, all that. And then as it's passed through investors, we are seeing pricing compression. So we did suspend the 12% program. So if you're a longtime investor, we did have a tier of 8, 10, and 12. Now, and we got rid of the 12 for those that had $1 million or more. And we're in the process of either returning money to those investors that were earning 12 with $1 million plus, or asking them to accept 10%. And that's a factor of the fact Dave mentioned it, like this space is very popular. Private lending, when you get secured assets, high yield, it's become the darling of Wall Street in many respects. And that means tens of billions of dollars are entering our space every month, and many of our competitors are pricing lower to gain market share. We're not unaffected by that. We are somewhat. Now, we still charge higher because of our customer service and the way we lend. And people are willing to pay a higher premium for that. It does matter in the marketplace, especially when you have speed and certainty of closing. But as it applies to our capital stack, we are actively in the process of reducing our capital. Do I think the 8 and 10% programs will change? I don't think so, actually. I think we probably wouldn't even be personally interested if we have to lend below 10 on a permanent basis either, right? Like we probably wouldn't have a business that we want to be involved in, and we'd probably just shut down the fund or something like that if that happened. I don't think it will, but if that ever worst case scenario happened. But for the 12% investors, they do represent a sizable portion of our weighted average cost of capital. And so we must adapt and remove that from
We
our,
often,
which we did.
yeah, and the question I get all the time is, "Oh, Dave, I know that interest rates are high now, so when they go back down, to borrow money from private lenders will be cheap." And the fact is, we've kind of seen the test case, right? When the Fed's fund rate was, zero, what was happening? Well, nobody was, private lenders weren't lending at 5% in those scenarios, right? So we know there is kind of, a floor, so to speak. But the race really now is to get the right borrower, the right clients. Sometimes there are clients that are willing to pay 14, 15%. That's not the client we want, because they probably don't have good credit or good experience, which means the likelihood of paying off is low. What that means to you as an investor is we could certainly continue to pay you out at 12%, but our losses in those situations would amount to something that would be a loss for you. And so we, look at this as a responsibility to be a steward of your capital. And the only way you can do that is at a lower price, which is why we went from that 12 down to that 10. And again, it's survive in advance. It probably applies to the investor side just as equally, right? Is we want to provide those type of returns for you way into the future, as opposed to give you a 12% return and be out of business in 2 years. Like, that's not very helpful for you or us. And quite frankly, I hope that all of you are sleeping better at night as a result of that, because the 200 basis points that you might be wanting, if you only get them for 2 years, your yield is not, going to be that great.
Thanks. Yeah. Any other questions? We're going to end it in a minute or so. If there are no other questions, feel free to reach out. Here's my contact info. Please reach out if you're interested in investing, or if you got any questions, I'll pass it on to Dave as well as it
Yeah,
pertains
and
to.
here's my contact
Oh
information
yeah,
right
that's
here as
right.
well.
Yeah.
So, yep, you've
Yeah.
always got that, and always make myself available.
Yeah. All right. No, doesn't look like any other questions. Dave, thank you so much for taking the time and explaining this
Great.
great presentation. And for those of you joining, thank you again for joining us today. And until next time, see you later.
Have a good one, everyone. Thanks.